Well, and I'm the Chuck in the Markets Up Chuck, and this week's vlog I'm going to dedicate it back again to earnings determined market price. I talk about this often, but I don't feel I can talk about it enough. In the long run, the stock price of a company is going to correlate and follow its earnings, even though over short periods of time that can get disconnected. So let's start by taking a look at Briggs & Stratton. And by the way, before I get into that, let me make one other comment. There's a lot of volatility showing up in the market, certainly. There's been a lot last year, and we're seeing some again this year, and prices are rising. And this volatility in the long run, you can have a great deal of confidence that the relationship between earnings and market price will inevitably prevail. And so if you can basically understand where the earnings of your business are and then measure that against your stock price, you can really make intelligent decisions and not let emotions corrode the framework of your intellect. So let's take a look at Briggs & Stratton first. Well, here's a 20-year chart, period of time where earnings went up and stock prices followed that. Again, there's always going to be volatility. Notice that stock price or earnings fell and stock prices kind of dropped along with it. Then we had a rise in earnings again, a rise in price. Earnings collapsed. Stock price fell. Then we had this 3 or 4 year period where earnings were strong and stock price followed it. And then more recently, earnings have collapsed and so did stock price. And you could make a very strong case that Briggs & Stratton is overvalued today. If you own that stock, you might want to take a look at its current valuation. Eastman Kodak is a classic example of a company whose earnings have just continuously deteriorated over the last 2 decades. You can see their stock price is correlated to that, and there is a strong correlation between earnings and market price. But as stock price collapsed, it collapsed because earnings collapsed ahead of it. And ultimately, in the long run, it's earnings, that determine market price. And then, the last individual example I'm going to show is TJX companies, better known as TJ Maxx stores. I like this chart because if you look at the first 5 years here, you can see that there's been a very strong correlation between stock price and earnings. And stock price was very flat. And so were earnings relatively flat during that period. But you can see that, since 1996, we've had this very consistent, strong, acceleration of earnings growth, and stock price really tracked that and correlated that very closely. There were short periods of time where it got overpriced. Inevitably, it comes back to earnings. There were short periods of time where it got underpriced, and then inevitably it comes back to earnings. The recession saw the earnings flatten a little, but this company is obviously a very, price-driven retailer. So, for the economically minded, you can actually get some real great buys and great bargains here. And, the stock price fell dramatically, but look how quickly it's recovered and come back to earnings. In the long run, it's earnings that determine market price. And finally, the last example I want to show today is the example of the stock market as measured by the S&P 500 as a proxy for the general market. And I wanted to make a couple of points here. If you look at the last 15 years, since 1996, there was this irrational, exuberant period where stock prices got dramatically overvalued. And of course, I would have told you they were overvalued here, I would have told you they were overvalued here, I would have told you they were overvalued here. And even though they continued to go up, inevitably, the rubber met the road and they came back into value. Then we had this period coming out of the recession of 2001 where earnings grew dramatically, and you can see there was a very strong rally in the stock market. And then, of course, we hit the recession. Now, here is the conundrum. The reason I'm mentioning this is this. Right now, the stock market normally trades between 15 and 17 times earnings. That's historically been the PE. This green line right now represents 16.6 times earnings, which is kind of a more modern version. It's a little higher than the historical 15 because obviously we've had a period here where prices, and price-earnings ratios were very high. But my point is simply this. On that basis of, this being a normal value, 16.6 at 19.1, it is arguable that the market is pricey. And you could see that the stock market could drop. In other words, I wouldn't, be surprised to see the stock market trade at 950 because I think that's actually what it's worth right now. And I thought it was a real bargain at 735. However, that's year-end calendar year 2009. On the other hand, I also would argue that the market probably by the end of 2010, based on the $71 current estimate for earnings of the S&P, the S&P value could be close to 1,200, which would be a kind of a nice profit from here. So the real bottom line is, making short-term decisions and long-term decisions are not necessarily the same. The stock market may be expensive right now, and that doesn't mean all stocks are. Just to put that in perspective, let's take a look at a 15-year chart on Fiserv. As you can see, the market is always capitalize this company at a premium to its growth rate. It's an 18% grower, 17.8% grower. It only trades at 12.8 times earnings, which is significantly less than the market, yet it grows right now about 3 times faster. You know, you could argue that this would be a $65 stock that's trading at 46. So just because the market may be overpriced and may go down doesn't mean that your portfolio or stocks that you own go down. You have to measure each, in my view, look at each individual case on a case-by-case basis. This is the first in this week's series on earnings determined market prices. Chuck Ramos, and thanks for listening. Hope you tune in again tomorrow. Talk to you then.